Stocks trying to rebound after posting their worst week in more than a year. But with the recent spike in volatility and economic concerns, how should investors be positioning their portfolios into the final months of the year? Joining me here at Post 9 is Elizabeth Burton of Goldman Sachs. Elizabeth, great to have you here.
Thanks for having me.
So the S&P 500, it's only 3.5% off a record high. Seems like that's no big deal. We're up nicely for the year. On the other hand, some of the big winners of the first half have had a hard time, and it's been tough to figure out if the market's fragile based on the economic outlook. So I guess what are the conversations you're having right now with a lot of your clients with those things in mind?
Well, first of all, the conversation has shifted a little bit. So back in May and June, a lot of clients were still asking about inflation and what the outlook was like. The past 2 weeks of travel for me, no one's really asking about inflation. They're asking about U.S. growth risk. So as you know, I mostly serve our U.S. institutional client base. And even though they've got diversified portfolios, at the end of the day, 80–90% of the risk is still tied to U.S. growth risk. So they're asking about, what do I deal with that? How and when should I add back duration? Some of them have cash balances. What should I be doing with that?
And what are you telling them on those scores?
Yeah, fair enough. So on the equity side, some of the similar things have been repeating throughout the year. We're still constructive on small caps. We think now you might want to look at low vol and defensive strategies to kind of tamp down some of the risk in your portfolio. And look abroad, as usual. One thing we're liking right now is UK equities, FTSE 250 over MSCI World, for instance. So trying to diversify from that perspective. Also long-short exposures and, extension strategies, maybe lowering tracking error. On the flip side, on the duration side of the equation, I think that's really hard for me as a former allocator in this environment to sort of thinking about legging back into duration. But we still have clients that are rebuilding their fixed income positions.
Just because you've had such a run in terms of longer-term bonds?
So, and adding it back in, yeah. I think, well, look, the position of Goldman Sachs is that the inflation story is looking better, rates are going to come down, but having been an allocator, I'd still be concerned that inflation might stay sticky and there's risk to the upside, and 10-year might have risk to the upside, thinking as an allocator.
In yield,
sure. Right.
Yeah.
So those are some things that I would have concern about, and also a lot of these institutions have to rebuild their fixed income. They actually took it down, let's say, from 20% of their portfolio to 5% of the portfolio when rates were near zero because you're not earning anything. Yeah. And now they're saying, okay, I've got to get back in, but how and where do I get back in?
The idea of equity long-short strategies being somewhat attractive here, I guess, what role are they supposed to play in a portfolio? And is that a call on you think stock selection is going to all of a sudden be rewarded in a bigger way now?
Yes, so you'll always find me saying I think stock selection is important and active management is important. For one thing, for institutions, adding long-short equity might be easier than literally looking for deviations from your benchmark, right? So if your benchmark's MSCI World, it might be hard to add a telecom manager, but it might be easier to add long-short in that context exposure to get rid of some of that beta risk that you have in your portfolio. So I think that's one facet of it.
What's the current thinking on private credit as I guess the whole boom is getting somewhat tested by a period when at least we're worried about slower growth, we're worried about the possibility of default risk going up?
Private credit's still a hot topic for investors. I think we're shifting a little bit from private credit 1.0 to private credit 2.0. We're looking more at specialty finance and more niche sectors of the private trade. But look, we're still super constructive on private credit as a whole. There's a lot more room to run there. I think you'll see, who's wearing the bathing suits when the tide goes out on this one, because we really didn't see much of a blip in the last cycle. But things still look pretty good. It's still an attractive way to lock in yields.
Yeah, I mean, obviously, overall credit markets have been hanging in very well. It's not as if people are really getting super nervous. How are you thinking about just expected returns at this point? I mean, it's been commonplace to say, well, valuations are elevated and equities and yields aren't that high. The math seemed to say low returns is what you should expect, but we haven't really gotten them.
That's fair. Yeah. I was talking to an allocator the other day whose target is 7%, and while to some that may sound low, that's actually very hard to achieve.
Well, sure, for an aggregate portfolio.
For an aggregate portfolio.
Yeah.
But the good news is that actually the outlook for a 60-40 type portfolio, which not a lot of folks have, but let's say that's our base case, those actually look less risky and in a better place than they have been before. We actually did some work at Goldman Sachs, not my group, but another group, and showed that sort of the ideal portfolio you might want going forward is a third equities, third bonds, and a third real assets, but then take those real assets and put about 20% into real estate equities, infrastructure equities, commodity equities, and then the rest into TIPS. That's sort of the ideal, but that also still gets you back to 60-40. So Look, we're in a pretty decent environment, but we do think we are late cycle, which in general would mean overweight equities, underweight credit, sort of constructive on parts of the commodities complex, but not a lot of investors on the institutional side have any commodities exposure.